Thank you, Kurt. Now, let me just set the mood for everyone, the budget. I'm sure last Tuesday everyone was doing what I was doing. It's 7 o'clock, you're getting ready, you set yourself up on the lounge, you get a glass of wine, you put your blanket over yourself, and you go, what's going to happen? You know. If that's not what you do, let me explain the thrill of it. I don't think you'll understand. But you do that, you watch for an hour, you watch for an hour and a half. When they start repeating things for the third time, you say, okay, now I'm going to go to the computer, I'm going to open the budget papers, I'm going to read them, I'm going to find all the things no one's found yet, and I'm going to know before I get my 15 summary emails in the morning what's going to be in them. It's really exciting. So hopefully I've brought the energy up in the room, because this year was the first surplus in 15 years. Woohoo! And that was not the mood of the budget night, which was more sort of like this. Hooray! We're all so sad. Why was everyone so sad when it's a surplus? I think there's just a lot of stress with everybody, and also a lot of the reasons it's in surplus were not really good reasons to sort of spruik. So first of all, there's a lot of high commodity prices which have improved things, mostly as sort of a result of war. There's been a lot of inflation, which is causing a lot of pain, but results in higher tax collections. And the biggest improvement from the previous budget was just a decrease in planned NDIS growth, which obviously no one wants to talk about, as a major success, that they're going to spend less money on the NDIS. So, and there's no real plan of how to do that, other than that it's just going to be improvements that will just keep going, but it'll improve so much that it won't cost as much. The best thing, I guess, is that there is really high employment. So that always results in less spending on welfare. So that's kind of the best part of it that I found, which is maybe what that guy in the purple hat's thinking, because he's got a bit of a smile. But generally, I think everyone's feeling, a lot of pressure in the economy. Business has high costs of materials. They got high cost of labour. There is big pay increases going through to certain sectors, which is also causing a lot of stress with turnover of staff, loss of expertise, certainly a shortage of labour in many areas as well. And then, so non-businesses, individuals are paying a lot more interest. Certainly a lot of people haven't paid almost any interest for 10 years. Everyone just can't believe money isn't free. It's quite a shock to a lot of people now. Housing is not available and very unaffordable for many people. And a lot of people just struggling just with basic things like groceries and cost of living. So I think even though it's a surplus, everyone's feeling like they're walking that tightrope in the rain. So this is sort of me as well, sitting there going, oh no, why didn't anything happen? There is not anything transformative in this budget. Everybody, on all sides of politics, all of the think tanks, all of the tax policy experts saying there needs to be major reform, and there never is any. And it feels like you're just sort of sitting there with your glass of wine, waiting for something to happen, and it never is. So, what I've done is go through and pick out the biggest things that I could, but there just aren't that many in this time. And, I think that also adds to the sort of stress and the non-celebratory nature, because what's going to happen and when will it ever happen? It has to happen sometime. And I think, because nobody's very upset, that means nothing happened. Eventually, when everyone is upset, something will have happened. So what are some of the things though? And this is something that I think a lot of people talked about in the days afterwards. There was an offset called the Small Business Incentive for Energy Efficiency. So quite a lot of people were talking about, oh, what is this? We might spend some money on this type of expense and we'll get an extra 20% tax deduction for eligible assets which support electrification and efficient use of energy. So I did an example. We spend $10,000 on assets, we'll get a $12,000 tax deduction. So that extra $2,000 deduction will save us $500 in tax. So, $500 out of 10,000, it's a 5% saving. So it's something, it's not massive. We don't know what is eligible yet, and it only applies to small businesses. So you've got to have a turnover less than $50 million to get this offset, and you have to have them between July and June next year. You can't have more than $100,000 of expenses for it. So I think a lot of people are looking at this type of measure anyway, especially with a lot of increasing energy costs. So this is sort of my advice, is that if you're going to do this spending anyway, then look at it and maybe you get this bonus. But my concerns are, will these things ever get legislated? 2 years ago, we had, or a year and a half ago, we had 2 other types of these bonus tax deductions, which is sort of a trend announced. The technology and the skills and training boost, and they're still not passed. And one of them is about to finish in June, and the other one finishes next June. You don't know what's eligible, you still don't know when you'll get this deduction, and it's only 5% of the cost of the thing that you'd save anyway. So that's my advice, is do it if you're going to do it anyway, but otherwise I wouldn't be spending a lot of time changing major plans. The instant asset write-off was, this is a different measure about depreciating assets. So at the moment, it's been fantastic because the last sort of 2 years, if your turnover was under $5 billion, you could immediately claim any depreciating asset 100%. So that ends June 30, and from that date, there will be a limit of $20,000 as long as your turnover is under 10 million. Then you'll still be able to have $20,000 assets claimed 100% in the first year, otherwise they'll just be claimed over time. If your turnover is less than 10 million, the threshold will be $100. So if you have a $4 billion turnover, you then have to keep your asset register and depreciate anything that costs $110 over time now. So that's a difficult, impractical thing to do for very many places. And these thresholds continue to change all the time, and that's my message, is just please stop changing this and set some level that stays in place forever, because it's very difficult for business owners to know what's going to happen. I mean, we just pull out this table and go, okay, what was your turnover, which date is it, when is it, and you're looking through the middle of the year, trying to work out when someone got some, because, we've had 8 different thresholds in 8 years. It's a lot. There's a few superannuation measures. I think this is probably the biggest measure that was talked about before the budget, was the $3 million tax measure. So John will be talking about that. I was trying to find it in the budget papers and I couldn't find it for ages. So I was looking for like 30% tax on super, $3 million, but it was called Better Targeted Super Concessions. So that took me absolutely ages to find that title. They did change something which is a really good change in regards to non-arm's length income. So where you have a super expense that you don't pay at the commercial rate. So say, for example, I have a self-managed super fund and I do the accounting for it and I don't charge myself a fee. The previous law was that then the entire income of my fund was going to get taxed at 45%. So if I should have charged myself a $2,000 fee, but I didn't, and I have, $500,000 of income from dividends and rent, that whole $500,000 of income would be taxed at 45% because I didn't charge myself $2,000. So this change will make sure that that doesn't happen, and I would only get charged at 45% on twice the amount of that expense of the $2,000. So that is a really good change for anyone who might underpay an expense accidentally to a related party. Because we have a lot of self-managed funds that deal with related parties. And another big thing which will happen in the future is the payday super. So we've got 3 years, and then all the super is going to have to be paid on the day that you pay the wages. Yeah? Seems okay for most things, you know. We're doing sort of the single touch payroll now anyway, so most of the super is being reported on that day, it's just not being paid. But it will have a big cash flow impact. So I tried to think, you know, just work my way through, what is this cash flow impact going to be? And I just made up a lady named Julie, and she has a business with a $10 million turnover, and it's got a lot of wages. Wages are about 40% of her costs, so she's got $4 million of wages. The super's at 12%, which obviously is $480,000 a year. So she'd be making her quarterly payments of $120,000 each quarter. It's not going to be quarterly payments in future. She's going to have to make $18,000 a fortnight. So she's going to need some more cash, because she's not going to be able to have that build up and then make a big payment. And so she's got to either save some money before July 2026 or put in place some sort of cash solution, like maybe an overdraft facility. So my rule of thumb that I came up with, which was really clever, was just 3% of your annual gross wages being 1/4 of the 12% super. So look at what your wages are, do 3% of that, make sure you have at least that much cash, otherwise do something. Other measures, electric cars is something that I think is just a huge tax saving opportunity, and especially for businesses that are trying to provide benefits to their staff that would be interested in packaging a car. Because from last year, electric cars that are eligible, that are provided to staff, are not subject to fringe benefits tax. So normally, if I as an employer give my staff member a car and they just use it privately, I have to pay extra tax to account for if I had paid them the wages, they had paid tax, then they paid that car themselves. But if it's an eligible electric car, don't have to do that, don't have to pay any extra tax. So I did an example, and this is an article on the website as well. If you have an employee who's in the top tax bracket, and they have just a regular electric car, I think that I did off a cost of about $60,000, they could save $9,000 a year just by packaging that. So if you're trying to retain your employees, you know, just offering them that you could package that car that could save them $9,000 could be very attractive to them. The change in this budget was, or the announcement in this budget was that the hybrid vehicles will not be eligible from it's April 2025. So if anyone was interested in those hybrid ones, you've got to get those arrangements in place before April 25. That's still a long time away. And this can apply to anything that's got the cost below about $85,000. So it's a lot of electric vehicles as well. So I think this is a really big opportunity to look for providing staff benefits. Another measure was about the tax instalments. So obviously, as businesses making profits, the tax office assumes you're going to make the same profit and they want you to pay a tax instalment towards that next year's profit. That just indexes in accordance with GDP, which would this year have gone up by 12%. So everyone's instalments would have gone up massively, even though their profits may not have. So the budget put in an announcement that that's reduced to 6%. Hooray! So I mean, that still might not be appropriate. I mean, I think there's always the option to vary the instalment to what your profit actually is. You just need to have accurate budgeting and accurate figures to know what your profit actually is. So the instalment still will be increasing by a lot, but not as much as they would if they didn't make this change. But my advice is, do your calculations, each time to see if your instalment is too much, and if it is, vary it down, and we can obviously help you with that. Cybersecurity, I picked this out because I thought this has been one of the biggest business issues over the last year. That there was some catastrophic cyber issues for Optus and Medibank Private. But it's a big issue for all businesses, I think. I think anyone who has an email address obviously sees the scams coming in all the time, and it's becoming a huge issue where, we hear a lot of stories of people losing money or just how close they get to losing money all the time. So what is the government doing about it? They are committing $23 million over 3 years of funding to help businesses build some capability. It sounds like basically nothing, right? Which, I'm sure Medibank Private and Optus spent a lot more than that on their sort of situation. So what can you do otherwise to mitigate those risks? I mean, when we're talking to people, one option is often insurance, that you can insure against cyber fraud. And I think that's a really good option. To get insurance, you will have to take certain steps anyway of training, risk mitigation. And I think whatever your insurer makes you do is probably quite good as steps to look at, because they don't want to pay out money, so they're all about risk. And so if they want you to do it, it's probably a good thing in just lowering your risk. You're not going to be able to prevent everything, because if Optus and Medibank can't, then you probably can't prevent everything, but you can do basic things to make yourself less of a target and just lower your risk overall. And then if something does happen, you can recover those costs from that insurance. So I really think that's a big thing to consider, because just the cost and if it goes bad, can be so catastrophic. Scrap measures. I always like looking to see these. There was only one in the whole budget paper. Like I said before about those two other incentives that were announced a couple of years ago, a couple of budgets ago, there's a whole lot of things announced all the time that then never get enacted. So unannounced but unenacted measures, ABUMs, I think a lot of the tax community calls them. They scrapped one of them, which was this patent offset box, which was intended to give 17% tax rate, so quite concessional for income from patents where you've created the R&D for that patent in Australia. So it exists in a lot of European countries and encourages sort of the research and development there, and it's not happening here. So if you were doing a whole lot of research and development trying to get that, you are not going to. And then the last thing I wanted to talk about was about some missing measures. I sort of looked, well, was there anything? We thought maybe there would be something about them, and there wasn't. So these 5 measures of the stage 3 cuts, the temporary full expensing, loss carryback, skills and training boost, and technology investment boost. So these stage 3 tax cuts were not scrapped. They weren't talked about at all, and I think I'd be pretty surprised now if they went next budget. It seemed like now would have been the time, or otherwise, it's going to go to an election before anything happens. So I think these are going to come in, or at least have an election to remove them first, which means we will have these lower tax rates coming in soon. So really good for people earning $200,000 or more. You're getting a $9,000 tax decrease once they come in. If you're on 180, $6,000 saving, 120, 1875. So the stage 1 and 2s came in, 5-6 years ago, and this is the final stage for the higher income levels. It really removes a lot of the bracket creep as well that has happened over the last 10 years from having had no change to those higher thresholds. And by having not had them for so long, it's a lot of the reason for the improvement in that budget for this year of the higher tax take. As wages have gone up, people have just paid a lot more tax. So I think they're going to come in, which is will just not be removed. They've been legislated for a long time. So this is the temporary full expensing, so the 100% depreciation claims. You know, they were, I think maybe the key was in the title of it, that it was temporary full expensing. It actually is temporary, and it hasn't been extended. So back to, either $20,000 if you're under 10 million turnover, or $100 if you're above. You can see a few shakes of the head for having to keep those records. The loss carryback, that ends this year. So if you had a tax loss, for example this year, but you paid tax in 2022, so in the previous year, you could carry that loss back and get a refund of the tax that you paid. So this applied for 4 years, and it hasn't been extended. So this is the last year, if you make a taxable loss this year, that you can carry that back and get a refund when you lodge this return. Next year, if you make a loss, that loss will just carry forward until you make a profit that it offsets. So if for some reason you can bring a whole lot of expenditure forward with that, temporary full expensing, and you paid a lot of tax last year, and you could create a huge loss this year, you've got 6 weeks to do that. Because if the loss falls into next year, you wouldn't get the full claim of the depreciation anyway. But loss next year, there won't be a refund as a result of that. It will just offset future profits. And then the skills and training deductions. So these were the two measures that I mentioned, announced in 2 budgets ago, March 2022. So the skills training, you will have some bonus tax deductions of 20% of the eligible amounts. You still don't know what's eligible, and it's sort of making some tax planning harder, because if you spent a lot of money on training in this period, there could be a lot of extra deductions that you get when we do this 23 tax return, but we don't know what they are, and it may never pass. But at least that one, if it does pass, you can still spend it next year and get that bonus deduction. The technology deductions that have this bonus 20% deduction, they finish on June 30, and we still don't know what's eligible, and it hasn't passed. So this is my concern with the electrifying tax deduction bonus, is that it just may never get there. So potentially a good policy to just announce things, hope that people spend the money on it, then you never have to pay them anything for it. It just improves that market anyway. So that was the end of this session. Did anyone have any questions about anything just now? Or, Kim?
Can I ask the electric cars with no FBT?
Yeah.
Does that apply only to new purchases or second hand as well?
The electric cars and the no FBT, it's an eligible vehicle. I think, I haven't looked at whether it's a second-hand car purchase. So let me check that up in the break. I thought it was second-hand as well, but I haven't looked at it because I think most of them have been new. No more? Is that the only exciting thing in it that people are looking at doing? Maybe go out and buy 50 electric cars for all their stuff. All right, well, thank you very much. Hand over to Kurt, or are we up to a break?
We're off to a break.
Okay, well, we're off to a break. We'll be back in 15 for John. Thank you.
Welcome everyone. As Kurt said, it's great to be back at Factory 51. It's been a few years with COVID, so it's good to see you all face to face. And thanks, Tom, for keeping the audience lively. Hopefully, I can keep it up after a bit of pizza and a top up on your drinks. So let's whip into what I think is not so much the technical tax saving aspects of the budget, but more of the superannuation aspects of it, including how we can use that to our advantage to save tax and build wealth for our retirement. So let's get started. First of all, we always put up the disclaimer, and that's really just saying that the information you're going to see is general. So if you do need to apply it to your own circumstances, you will need to get personal advice for that. The other thing is, as sort of Tom touched on, some of the things we're going to be talking about today haven't actually come out as law yet. So there are some proposed changes in the budget. So we do wait to see those go through before we can actually use them in practice. So again, a bit like the tax side that Tom touched on, we didn't have a lot this year as far as superannuation changes go. But that's not to say that things don't evolve with indexations of certain items within superannuation legislation. So what we thought we would touch on is a bit of an update on where some of those contributions lie at, so everyone can see the landscape we're working in. And we've got a couple of the popular strategies that we're employing at the moment that clients are really loving and that we love as well. So we wanted to show you a couple of those. And also, again, the $3 million super balance tax. It was announced pre-budget. We take a little bit more of a deep dive into that. Again, it's not due to be legislated or come into force until 25-26. So the feeling is it will be part of an election campaign before it comes in. But it's certainly flagged and out there in the public, so we can have a bit of a look at that one. And then a couple of other items that we can sort of, dissect from the budget. So let's get started. So from the 1st of July, so next financial year, what's actually happening? Well, as you can see, nothing is changing on any of these caps that we currently have. So the concessional cap, which is your contributions that your employer makes, your salary sacrifice, any personal contributions you make that you want to claim a tax deduction on. The limit is staying the same next financial year at $27,500. So nothing too exciting there. And then we have the limit of non-concessional contributions. So that's the money you put in out of your own pocket. You don't receive a tax deduction for that. It does have a higher limit. We've got $110,000 there. Again, no change to the limit for next financial year. As well as that non-concessional, there are rules around you can bring forward to future years of contributions so that you could make 3 contributions in one go. Again, that's just a function of the number above. So there's no change there as well. So we've got the bring forward at $330,000. One of the things that did change earlier this year, on the 1st of January, is that individuals can make a downsizer contribution, and the age there has been reduced down to 55. Okay, so if you sell your house and you've owned it for more than 10 years, and it's been your principal place of residence at some point in that 10 years, if you sell that place, you can add an additional $300,000 once off into superannuation, okay? And that downsizer is very popular, doesn't have any caps, so it doesn't matter what your superannuation balance is or what your age is, you are able to make that contribution. So we do see a lot of our retired clients that are, perhaps moving into retirement villages or aged care facilities, topping up their superannuation regardless of their age and balance at that time. So That's a useful rule to know. And then what we've got is an expression called total superannuation balance. So that's something that's going to appear quite a few times in the slides. It's a summary of all your superannuation accounts, so whether they're in pension phase, or whether they're in accumulation phase, whether you've got them spread across 3 different funds, add them all up, that is called your total superannuation balance. And it does have a cap. So that cap is 1.7 million. Once your fund or your total superannuation balance gets above that, you can no longer make these standard non-concessional contributions. Okay, so that's what that cap relates to. So hopefully you're all still awake after that. There's a lot of things to get through, but that total super balance will appear in a few different occasions as we go through some slides, because it does, determine who can and who can't make contributions along the way.
Excuse me,
Yep.
how does the 1.7 compared to the 3 million you mentioned earlier?
So the 3 million, once you've got to 1.7 million, your fund can still keep earning money and grow to be higher than that. The 1.7 million is just a reflection of the fact you cannot make those non-concessional contributions anymore, but your employer can still make these contributions, and your fund can continue to grow with its earnings and returns and things like that. So there's separate limits, but there's a lot of people out there that have, well, it's not that many, but people with large super balances, and they could be historical as well. So these rules are only, reasonably new, but in the past there was a lot more ability to put money into super. Yeah. Any other questions before I move on? So a lot of these things here are if we're reaching all these caps, so they're good problems to have, okay? So next thing we're going to look at is some of the contribution rules. So we touched on concessional contributions. As I mentioned, they are comprised of your compulsory super contributions. So at the moment, the employer must put in 10.5% of your wage into super. If you make any voluntary or salary sacrifice contributions through your employer, they're part of this concessional contributions. And then rules changed not that long ago where you can just put cash into the fund and then let the fund know you want to claim that as a tax deduction as well. Okay, we call those personal deductible contributions. So those areas make up that cap. There is a tax on the way into super for these types of contributions, so generally 15% comes out, and you get a tax deduction. The current cap, as we mentioned, is 27.5%, and over the age of 67, you need to meet a work test to be able to continue to make these types of contributions. So if you're not working beyond 67, you can't put money in and claim it as a tax deduction. Okay. All right. So I thought it would be worthwhile just doing a bit of a history lesson here, because this does feed in a little bit to the $3 million super cap and the growth of the superannuation system. But superannuation had its 30th birthday recently, and obviously Paul Keating brought in the system back in the early 90s. When it first came in, it was 3% of your wage was the compulsory superannuation amount. So you can see, it took a while to increase, and then it got stuck at this 9.5% mark for, from 2014 up to 2020. And then there was an acceleration where it's now gone to 10, and then this year it's 10.5. Next year it is actually going up to 11. So everyone's going to get a bit more going into super, and then it goes up 0.5% till it hits 12%. So at this stage, that's where it's capping out. But the Labor Party previously has flagged that they did want to accelerate that 12% rate. They haven't announced anything yet, but it was part of previous election campaigns. And they've actually stated previously as well that they were looking to get the rate up to 15%. So superannuation's only going to grow, which does make it a bit strange that they're trying to tax it for balances that are over 3 million. So they're encouraging you on one hand to put the money in or forcing money in, and on the other hand, they're discouraging you to have a large balance. So conflicting messages from government, and we do hear a lot of clients have frustrations with the system because of a lot of these changes and inconsistencies that are there. But that's where it's at the moment. So one of the changes that came in when Malcolm Turnbull was in power was what we call carry forward concessional contributions. So this is one of our favourite and probably the most unknown strategy in the superannuation environment, I think. So this rule came in 2018-19, and what it said is that if you didn't use up your cap for that year, you could carry it forward. Okay, so you could use it in a future year down the track. There were a couple of conditions that were put around it. So one is your balance has to be less than 500,000 at June 30 of the previous financial year. So for us now, that would be June 30, 2022. And you can only carry forward a maximum of 5 years. So it is now 5 years since it came in, so we're going back to the first year that we were able to do it. And to give you an example of how it works, if in 2018-19 you had no contributions, you're self-employed, you put nothing into super, your cap for that year was 25,000, so you're actually able to carry that whole 25,000 forward. The following year, you also put nothing in, the cap was 25, you've now got 50,000 of unused contributions that you can carry forward, and so on and so forth. So if you put nothing in for the last 5 years, this year you can actually contribute 130,000 into super and claim that as a tax deduction. Okay, so people may have an idea of where that might be useful. If you sold an investment property and had a large capital gain, you've got the ability to tap into those contributions in this financial year. All right, I think my microphone, there we go. Everyone hear me? Yep, cool. All right, so we'll look at a worked example of that. So let's have a look at Harry. So he's got a super balance of 400,000. Now, that is less than 500, so we tick that box. He sells an investment property. He has an assessable gain of $200,000. So normally that would be taxed at his marginal rates. If we look at the last 5 years, Harry comes in to see us. We go back to 2018-19, and we work out that each year he's only used up $10,000 of his caps in each year. So first year, he's got 15 unused. That adds up to 30 for the next year, 45, 62.5. He's got 80,000 of unused caps over the last 5 years. If he uses proceeds from the sale of that property, adds that to superannuation, claims a tax deduction for it, he will save $24,000 in tax by doing that. So it's a very powerful strategy for those that are able to use it, and we've certainly put a lot of clients through this process, so with great results. So that's an excellent strategy. Any questions on that one? No? Excellent. All right. So that sort of wraps up the concessional contributions, looking at where the limits are and how we can use those catch-ups. The next thing to look at is non-concessional contributions. So as mentioned earlier, these are money that you put into super, you don't get a tax deduction for it, there's no 15% tax taken out on the way in. So we call them non-concessions, no tax concessions. The maximum you can do is the 110,000 per year, but your total super balance must be less than the 1.7 million to be able to make 110,000 non-concessional contribution. There's also age limits on this one. The age limits were recently changed, so it used to be 65 was the limit where funds, you could make these types of contributions unless you worked. Now, anyone under the age of 75 during that financial year can make these contributions. So they've extended out the length of time people can add money to their superannuation. Okay, so it's a lot more generous now in getting funds into superannuation for people. So let's look at the bring forward rule. So the bring forward rule allows you to use those 2 future years of non-concessional contributions. Okay, so instead of just putting in 110,000, you could bring forward the next 2, put a maximum of 330,000 into super. You do trigger that bring forward rule by putting in $1 over the 110,000. Okay, so that's something to be wary of. As soon as you go over the 110,000, you trigger that rule. Now, if you thought some of Tom's tables were hard to follow, I think I can trump him with a few that are coming up, but there are also some staggered brackets where you are limited on what you can put in. And I think the easiest thing to do is start at the bottom. So if your balance, total super balance, is more than 1.7 million, you cannot make any of these contributions. Okay. However, if your balance, as at the 30th of June, was between 1.59 and 1.7, you can still do the 110,000. Even if it takes you over the 1.7, you can still do it as long as your balance was between those 2 amounts. If your balance was between the 1.48 and 1.49, you can do 220,000 up to as a maximum. Okay, and then if your balance is less than the 1.48, you've got the ability to do a full 330,000. So I guess the take-home message there is if you've got balances around this amount, which is a good problem to have, just make sure that you're aware of the rules or get some advice around that before you make any large contributions into the fund. So let's look at an example. So Charles, age 68, I think that's a bit generous. Total super balance of 1.1, I suspect it's probably higher. Did recently receive an inheritance, expected a bit higher than that as well. So let's look at Charles's ability to contribute into super. So his balance is less than the 1.48, so he can use the bring forward rule. So he can contribute 330,000 right now, trigger that bring forward, and he therefore will not be able to make any future non-concessional contributions until 1 July 2025. So he's used up the next 2 financial years by putting in the 330,000. Okay, so that's a way to get 330,000 in this year. However, if Charles comes to see us and he's keen to get more than 330,000, what we would suggest to him is that he puts 110,000 in now, not triggering that bring forward rule, and then in July puts in 330,000. So because we're quite close to June 30 at the moment, if he's in no rush to get funds in there, we just spread that across 2 financial years to maximise how quickly he can get those funds into the system. And in that scenario, he can't get anything in until 1 July 2026. So it's just around making sure that you're aware of the rules and how to use them to your advantage to get the maximum amount into superannuation if that's your goal. Any questions on that scenario? I'm sure Charles is well looked after. He doesn't need the money. Now, one of our other very popular strategies at the moment is called a recontribution strategy. Okay, so let's have a look at what this one involves, and it really came about with the recent change in allowing clients above the age of 65 to be able to contribute into super. Okay, before that, remembering they had to work. Now anyone basically under 75 can add money in without working. So superannuation, for those that aren't aware, when paid to spouses or kids, does have some tax implications. All right, so if you were to pass away and your superannuation was paid to your spouse, a child under 18, or someone who was financially dependent on you, then no tax is payable by the recipient of those funds, okay? But what I do need to point out is that if you check your superannuation statement, what you're going to find is, and it'll be somewhere on the back pages, just under the terms and conditions, is the breakdown of some components within your fund. Now, one of them is called tax-free, and the tax-free amount comes from non-concessional contributions, money you put in out of your own pocket, okay? The other component is what we call taxable, okay? And that's your concessional contributions, your employer, your salary sacrifice, things you've claimed a tax deduction on. So the key is down here. If you were to pass away and your super was paid to your children who are over the age of 18, what happens is the tax-free component, they don't pay any tax on, but the taxable component gets taxed at up to 17%, okay? So there can be, you know, especially on larger superannuation balances, some significant tax that's paid by recipients of superannuation when you pass away. Okay, so now we've got the ability to withdraw money and contribute back into the fund to change the mix of these tax-free and taxable components. I'll give you a bit of a demonstration. So we all know Camilla. Again, a little bit generous with the age, I think there, but let's say Camilla was 65. She had 400,000 in her super fund, of which half of it, so 200,000, is tax-free. So she's put that money in out of her own pocket, and 200,000 is a taxable component, so from her employer, salary sacrifice, etc. She's 65, she's still working, she can still access her balance even though she's working. Her total super balance was less than 1.48, so we tick that box, so she is actually able to contribute funds into super. What she could do is withdraw from her super $330,000 and put it back in, okay? And I'll show you what the impact of that is. Now, when you withdraw money from your super, you can't elect to say, well, I'm gonna take it all from this taxable component, because that'd be, too easy. What the rules say is that it has to come out in proportion. So here it's 50-50 between these two components. So the 330,000 would be 165 from there and 165 from there. Okay, I'll show you the numbers. All right. So initially, tax-free component was 200, taxable component was 200. She's withdrawn in proportion 165. She's left with 35,000 of the tax-free and 35 of the taxable. She actually has to take the cash out of the fund, by the way. So the fund hits her bank account. She then deposits it back into her super account. It goes in as a completely tax-free component, okay? Because it's a non-concessional contribution. So what she's left with is still a balance of 400,000, but now she's transformed it into 365,000 tax-free and only 35,000 taxable. Okay, I can see everyone's, taking notes madly. So what she saves in tax, Camilla, is $28,000 to her estate. Okay, so again, for a simple exercise of drawing money out and putting it back in, Camilla's able to make a significant tax saving to her estate. So it's a strategy that's only just become available because these rules have only just changed last financial year. Okay. Any questions on that one? Everyone loves saving tax, don't they? Can she give it to Harry? I think Harry's cut out of the will, actually. So I think William gets the lot. All right. Now, I hope everyone's awake because this is where stuff really starts to get serious, okay? So we've talked about total super balances, adding money to super. When you retire, there is a limit on how much you can put into a pension account, okay? Because pension accounts that you start drawing money from, earnings are completely tax-free. All right, so it used to be no cap on how much money you could put into your pension account, so people put their whole balance into a pension account as soon as they could and got tax-free earnings, tax-free income from it. Government didn't like that, balances were too high, so what they've now said is that there is a limit on how much you can have in a pension account. Anything over and above that has to stay in the accumulation account. All right, so we call that the transfer balance cap. It's indexing. All right, so at the moment, it's currently 1.7 million, which was nice because it was the same amount as the total super balance. All right, so we only had to remember one number. Now we've got to remember two. So it's actually indexed by $200,000. Okay, the balance cap from the 1st of July is going to 1.9 million. So the reason why it's indexed and the total super balance isn't is they have different measurements that they use to index it. So surprise, surprise, this index is done with CPI, and CPI has obviously gone up a lot. And it's the first time we've seen a double indexation. So it used to be 1.6, went to 1.7. Now it's doubled to 200,000, sort of to 1.9. So we're dealing with two separate caps, which makes our jobs fun. And yeah, that's coming into effect from the 1st of July. Now that was actually the easy part of this section. The hard part is the fact that every individual will have their own personal transfer balance cap, okay? This is the general one. So those that have never used or started a pension, they have the general cap. Anyone who has started a pension has their own personal cap, because you don't get the indexation if you've already started a pension. You only get it proportionate, or if you started a pension today with 1.7, you're done. You can't add any more. You can't get to use this extra 200,000. Okay, you get your cap the day you start your pension. All right, and that's called a personal balance cap. All right, so the take-home message here is don't start an allocated pension or account-based pension prior to 1 July 23 if you're going to use that cap up. Okay, because the maximum you could use is 1.7 million. Whereas if you waited a couple of weeks, you could actually put in another 200,000 into that tax-free environment, and that stays there forever. So just a bit of a call out, obviously, these are good problems to have, but there is just that call out there. Now, does anyone remember these guys? In 2007, they came out with what was called Simpler Super, where they pretty much abolished all the rules and, just made it simple, okay? And they were lauded for it because it had been quite complicated. So basically went back to zero, to ground base, and everyone had a grand old time under these simpler super rules. So we're 16 years later, and this is what we're left with. So if anyone's wondering what their personal transfer balance cap is and how to calculate it, simple. Follow these 4 steps. You just need to determine the maximum amount of the personal transfer balance cap that's been used and the date you used it. Then you calculate the value above as a percentage of the personal transfer balance cap on the date identified. Then you calculate the unused cap by subtracting the percentage in step 2 from 100%, and then you just round it down. So pretty simple stuff. I think the system's working well. So I'm not going to bore you with all that. Again, if you have any issues with these sorts of things, it's best to get advice on it so you don't stuff it up. It's good for us, it keeps us in jobs, but it is no longer simple super. Okay, now the big ticket announcement, which was actually not on budget night, as Tom mentioned, was barely in the papers. Had been announced earlier, was the $3 million total super balance tax. Now, this is the quiz part of the section, so if everyone's still awake, there is an opportunity, not umbrellas, but bottles of the finest Chandon. I think it's fresh, it's this year. So what we're looking for is someone to throw the closest estimate of how much money is in the Australian superannuation system today. Does anyone want to have a crack at what that dollar amount is? So this is everyone's super balance is added up, and Jasmine's not allowed to have a go because she knows the answer. Anyone other than staff want to have a crack? Throw a number. Was that 1 trillion? Anyone else? Anyone want to have another shot at it? How many? 2. We got 1, 2 and 3. It's actually 3.4, so I'll hand over the bottle of Shandon. Well done. Good guess. Now to put that in perspective, that is actually greater than the market capitalisation of every company listed on the Australian stock market. So if you put that, if you think about that like us nerds do, the Australian super system could buy every company listed on the stock market, okay, and actually still have money left over. So that's a big super system. It's actually the 5th biggest super system in the world as it stands right now, and it is considered to be one of the model super systems of the world. So despite all the complexities, it is actually a very effective system, probably too effective, and that's why we've got these taxes coming in, because there's another bottle here, and you're all wondering what that's for. Does anyone want to have a guess where the super system will be in 20 years' time? Forecast, obviously. You can't win again. 16? 25? Oh, who's that in the background there? Someone's just come off a cruise, I think. Anyone else? 40? It's a little bit less. I don't want to, ruin the surprise or anything, but 35? Keep going down.
33.
Oh, okay, we're way down. Way down. Keep going way down. It's single digits. Come on. 9. There we go. It's going to be $9 trillion in 20 years' time. There we go.
I'm sorry. Thank you.
Well done. So let's have a look at that, how it's graphically progressed. So we've got the green section, if you can see that, that's the actual data, and then the blue is where it's forecast to get to. So by 2040, it's estimated to be $9 trillion. So what government doesn't want a piece of that action? Okay, so there's a lot of spending issues coming up. There's a lot of ageing of the population, proportion of people on, in aged care, on age pension, all those sort of things. Less people working. How are they going to fund it? You've got $9 trillion potentially available as a tax source. So it doesn't take much to convert $9 trillion into a significant, boost to the budget bottom line. Okay, so hence the start of the $3 million total super balance tax. Not forecast until 25-26. Still needs to get through an election to be passed. No legislation available yet. But what we do know so far is that any balance above, the earnings are going to be taxed at 30%. All right. Now the government states that it's only going to affect 0.5% of the people with super balances. But when we look back at the growth of superannuation, that number is actually going to increase quite significantly. So principle, people go, well, if you've got $3 million in super, you probably should pay a bit of extra tax. A lot of people are comfortable with that. Not many people are affected. However, some of the mechanics of it still need a bit of working, and that's what we're going to just dive into quickly here. So the big one is really the fact that there's no allowance for indexation of that $3 million. All right, so by 2050, the forecast is that 10% of balances will be above that. Okay, inflation, growth, they want you to put 15% of the money into super. So they're pushing funds into there, and the amount of people with $3 million is just going to naturally grow over time. So there's no allowance for that to be indexed. So it's a bit of a catch for people down the track. The other one is the way they've talked about taxing it is the tax is going to be paid on just growth in your fund. So it's not on income. So if you have an investment and your fund grows from 3 million to 3.6 million, then 600 grand of that's taxable, whether you've crystallised that or not. Now, I read some fairly strong language about it where they say it violates generally accepted tax principles. Normally you only pay capital gains when you realise an asset. This tax is designed currently to just tax on growth, not realisation necessarily. What it potentially may do is it may make people with balances above 3 million to actually pull funds out and invest them into other structures such as family trusts. Maybe that's what the government wants. They want less money in the system perhaps and force it out. So it may well do that. It'll just come down to the, looking at the tax comparisons between the different structures. The other issue is if you have a super fund and you're a small business owner, you've bought your premises, over time that property's gone up in value. You hit the $3 million cap, the next year it goes up to 3.6. You may not have cash in the fund to pay the tax that's there. So potentially, as it sits, the fund may force you to have to sell that property just to be able to fund that tax payment. So there's no talk about how that situation would be managed within this rule. So there's perhaps a few things to be ironed out before it actually does come in, but these are some of the initial concerns that have been flagged with the announcement of it. So watch this space.
You pay that capital gains tax and then GFC the next day.
And that's the problem, isn't it? Yeah, so it does set a high benchmark. So if it went to 3.6, you don't have to repay the tax until your balance goes up above 3.6. Yeah, that's what it's designed to do. Yeah, but that's a good point. Yeah, I mean, Tom and I were talking the other day about a client of his that had some Bitcoin, and he looked at various prices of Bitcoin and the range of the value of the fund over the last 5 years sort of put him at massive tax payments that have now, the balance has come right back down again. So there's all those sorts of issues that could come up. Yeah. All right. Moving on. So just wanted to finish off with just a few little, tidbits, a few other items. So just reinforcing that immediately 1 July 2023, the super guarantee charge is going up to 11%, currently 10.5%. Another change for anyone, around the 59.60 mark is that we've been on it feels like a 15-year journey where you used to be able to access your super at 55. And the journey was to get everyone to 60. That is now occurring on the 1st of July 2023. So from then, you can only start accessing super from 60. The other journey that we've been on is a change in the age pension age. It was 65. It's been progressively heading towards 67. That will now take effect from the 1st of January 2024. So all those sort of provisional years are now taken out, and we're set with 60 and 67 for preservation age and age pension age. And then lastly, for people that are currently have an account-based pension for the last 3 financial years, it was one of those COVID measures where they allowed individuals to take half of their normal payment from their allocated pension or account-based pension. It was sort of a measure so that people didn't have to sell assets while they were down during COVID. It did get extended last financial year and then again last minute for this financial year. There was no mention of it in the budget, so the expectation is that, there's 6 weeks left, but we haven't heard anything, so we're just expecting it to go back to normal withdrawals. Hasn't been mentioned yet, but of course there was the $500 electricity bill relief for eligible households, so anyone on sort of, government cards, age pensioners, Commonwealth Seniors Healthcare card holders will be able to take advantage of that. And one of the measures for encouraging pensioners to join the workforce, because there's such a shortage of staff out there. There was special provisions to allow extra income, so it didn't affect age pension, and that measure has been extended until the end of December. So you can work and earn $4,000 without taking an impact on your age pension. So a couple of little items there that got mentioned or didn't get mentioned in the budget.
All right, well, thank you, Tom and John, for your presentations tonight. Hopefully everyone's got something out of that, and hopefully there's some questions to come as well. I couldn't help thinking during that, particularly with some of your slides, Tom, on depreciation rates and the changes over the years, and John with yours with different super rates over the years as well. We probably could play a game of guess the Prime Minister in each of those years as well, but I'll save that for next time. So I've got a few questions here that have been submitted, but was there any other questions that we wanted to start with from the audience? Oh, Tom.
Can I just answer that question that Kim asked before about the electric vehicles and whether they have to be new or not? So they don't have to be new, but it has to have been acquired and first used after 1 July 2022. So the example that I found had someone ordering the car in February 2022, it arriving at the end of June 2022, but they don't give it to the employee until July 2022, so that's okay. And then if they sold that to someone else, that person could also have it exempt because it wasn't first used. But they would have to find out, did the previous owner use it in June or July to work out whether they're eligible for the exemption or not.
I think that's part of the standard questions on carsales.com, isn't it? Yeah. Does that answer your question, Kim? Yeah. We might start then just with some general comments from each of you. In your presentations, you sort of talked about the impact of interest rates and inflation. Tom, you particularly talked about that at the start and the impact that has on business. But could you each maybe make some comments about the impact that that's having on businesses and your clients from the investment side of things and tax? Are we back on?
Okay, yeah, well, with the higher interest rates, financing is suddenly important because you actually have to pay for it. So, yeah, I think efficient use of capital is something that hasn't been really necessarily focused on for a long time, but really now looking at, okay, well, I have this debt, am I using the assets that I've got with it appropriately is something to look at. And also, what is the interest rate you're paying? Should you actually pay off debt? Because the answer usually would have been, well, it doesn't cost anything, so surely you're able to make 2% out of borrowing it. Now, are you actually making 6-7% out of borrowing that money? Or, if you have surplus cash, should you consider paying some of that off? So that's things we haven't looked at for a while. Also, with those repayments increasing then, especially if they're P&I, looking at projecting your cash flows as to whether you're going to run out of money, because people haven't had to do that for a long time. I think, a lot of people who don't have cash flow projections really need to do them to work out, as those rate rises start to bite, when are they going to run out of money if they don't do something about it?
Yeah, very similar here actually, Tom. But one thing we are also noticing is that the equilibrium between people with cash and borrowers is sort of now coming back into the market. So, previously we were seeing term deposits leave banks in droves as people were chasing naturally higher returns, and that can cause people to go into riskier investments that perhaps are not really suited to them. Thankfully, we haven't seen, or we don't do that obviously, but the concern is that could be out there in the market. But we are seeing clients with cash balances now starting to get a decent level of return on their term deposits, which is sort of not often focused on with the media. They always just focus on the people with debt rather than the people that had $1 million in cash getting $1,000 a year in interest. That doesn't feel right. And I think now with rates back to where they are, we're seeing that sort of much more comparable. So that's been good. I thought this question might come up actually, Claire. So you're all in for a bit of a treat because I have actually prepared a slide for this one. So excellent question to whoever submitted this one. So what I've just done here for you is, this is sort of latest data on where the forecasts are for interest rates in Australia. Now, there's 3 lines here, but the interesting thing about it is that 6 months ago, so the dotted orange line, that's where rates were forecast 6 months ago. So sitting at around the 3.25, tipped to go up to sort of 4.25, long term, but on a steady trajectory. Then we had the Silicon Valley Bank collapse, and that was the first indicator globally that interest rates were starting to work, okay? We hadn't really seen inflation come down dramatically. We hadn't seen unemployment go up. Economies weren't necessarily slowing until we got the collapse of that bank. And that caused everyone to sort of pause and say, maybe this is starting to work and maybe we just need to ease up and see where this ends up. So a month ago, we saw the green dotted line, which is forecasting for sudden rate cuts, okay, and a much less steady increase over time. Since then, the US government's pretty much bailed it out. Credit Suisse got bought out, so there's been a bit of resolution in that area. And now the dark blue is what the forecast is. So in the next 2 to 4 years, there is still rate cuts on the horizon before things stabilise and then we get a steady long-term rise. But I think we're heading into a higher for longer rate environment, but we just need to see what the pain is going to be and when it does appear in housing, unemployment. If they go too far, they can always cut, and that's what we're just waiting to see, and that's what's affecting the share market as well, your investments. So we're in a transition period where we don't know where it's all going to end, but that's what the forecast is.
Thanks, John, for that very quickly prepared slide and information. Just sort of staying on the cash flow side of things for a little bit, as Tom mentioned, it sounds like there's really just a lot of tinkering around the edges. There's not a lot of tax reform at the moment, despite your photo of our, last year's Christmas party with everyone's celebratory hats on. So there's a lot of tinkering around the edges, but there's also some of those changes are really having an impact on cash flow. So we were talking about whether it's tax instalments, the proposal for super to be paid at the same time that you're paying wages, that sort of thing. I think it probably highlights the need for those cash flow projections, for systems to be in place, for businesses to sort of be set up appropriately to be able to handle those changes. Feeding into that then, I guess, just from the superannuation side of things, is this proposal with the $3 million change. And, business is one side of things. They can probably cope with cash flow changes and are quite used to having to adapt to those. But when you then go and place these changes on super, if we're starting to tax unrealised gains, did each of you want, I know, John, you sort of explained it in your presentation about how that works, but did you want to just go through that a little bit more, Tom, and maybe explain how structuring might change with that as well and what decisions might look like if you're suddenly being taxed on unrealised gains in super, how that might change?
Yeah, when I saw the proposed change, I went, oh, okay, I understand what they're doing. You'll have a 0% rate from your, 0 to $1.7 million balance or $1.9 million balance. Then you'll have your 15% rate from 1.9 to 3 million, and then you'll have a 30% rate over that 3 million. And you'll just go, okay, what's the taxable income of the fund, and apply it in those proportions. That's not what happens at all with this $3 million thing. What happens with this $3 million thing is you completely ignore the taxable income of the fund and you just look at your total super balance. So what was it last year? What is it this year? If it's gone up, then that's what you're paying the tax on. And it doesn't mean you've necessarily made any income in a realised sense. It can be unrealised. So just the value has increased, but you haven't sold anything. So that's definitely worrying because, where you have those volatile things, volatile type investments, but they just hit a price spike on 30 June and then they've come back down, what do you do? Because, well, you're going to have to pay the tax, you might have to sell it, and it might have decreased in value at that time. This happened a whole stack in the last year with employee shares as well. So, you know, a whole ton of people who work for tech companies that get paid not that well, but they get granted a lot of shares in case they become valuable, and then you get taxed on them when you get entitlement to those shares. And so their shares kind of vested that they became entitled to them, but then all those prices crashed. So they're getting taxed on the market value of them, but they haven't sold them. So it's sort of also going, okay, well, if you get these employee shares, you immediately need to sell them, otherwise you might end up with a disaster. But that's completely you know, I mean, when you offer employee shares, you want people to keep the shares in the company. So it's not working very well from that point of view. And I just think if you have something very stable as an investment, you would probably keep it in because 30% as a rate is fine anyway. But if you have something that might move around, it could be much better to just take it out. Leave it in something that's going to get a 30% rate anyway. Not have to worry about the death benefit tax.
Yeah, and I think also, you know, continually tinkering with the rules. So this one in particular, no doubt it'll be pushed through because it's a tax on the rich and they can afford to pay it anyway. But we have seen that, you know, over time, a lot more people, you know, many people younger in this room over the next 30 years may well hit that balance. And what it does is it erodes confidence in the system. So when people think they're going to continually change the rules, people are going to be less inclined to invest in the system, and that's a worse outcome for the country. So, yeah, we do hope for many different reasons that that does get reviewed and that common sense will prevail, but yeah, we'll have to wait and see.
Thank you. I think we've had a few comments about sort of generational and shifting of wealth a bit earlier as well with those sorts of changes. We've got a question over here. Yeah, so the question is, how does that work with property and the valuations associated with that? You're right, Tess.
Yeah, so all funds now have to have their assets valued at market value each year, and you have to get, you know, reasonable evidence to support those values. When this happens, where you have things that aren't listed, you're going to be shopping around for values, right? And trying to manipulate those values all the time. So that's just because most of these balances are in, or very large balances, they're often in self-managed funds. It's the trustees telling you what the value is, organising the valuation themselves. So I don't really have a lot of confidence that it's going to be an accurate value anyway, compared to potentially when it's sold. And if it's in other funds, you know, retail funds, their values of things are often also, I think, manipulated to try to smooth earnings. So just the valuation issue is going to be really hot.
Was there any other questions before I move on to a few other ones that were submitted earlier? No. So one of the questions, just getting back to cars and things to do before 30 June, we're sort of 6 weeks out, so furiously starting tax planning at the moment. Tom, a question for you then is just on whether or not purchasing a car during this financial year would be of any benefit to a business.
Well, you'll get the temporary full expensing provision, so you'll get 100% claim, you know, up to that luxury car limit, so about $60,000 as the deduction. Whereas if you buy it next year, unless it's under $20,000 and your turnover's under 10, you will just claim it over a number of years. So yes, you get a bigger tax deduction this year, but you have to get the car before 30 June as well. So if you haven't done it yet, I think you're about 9 months too late.
And I think we've got 2 more questions left. Kurt's ordering himself a new car in the corner there. One of the questions is just around cybersecurity. So you mentioned around the sort of technology and investment boost, this announcement on cybersecurity, all sorts of, you know, measures that the government's trying to push to sort of help business modernise and that sort of thing. Just what type of cybersecurity are people looking at in business? What are you seeing? You mentioned about insurance before and steps that you need to take. Did you want to just expand on that a little bit?
Yeah, I think a lot of what people are doing is requiring training. So, you know, of the staff, what's a good thing to do, what isn't a good thing to do. Because that's often how the problems happen, is people just open things, click on things, do things they're not supposed to do. So there's a lot of people spending time on that training. That's definitely required by the insurers. And then just having an IT professional put in place whatever their systems are, you know. They send you out a whole lot of checklists and say, you know, you must have this type of antivirus, you must have this type of, you know, blocking software. So, you know, just most people are appointing those IT professionals to do that cyber protection. And a lot of the problems that happen that I see from our clients is where people just haven't done those things. Like, they just happen much more often. So, you know, you still have problems where people have done all the right things, but not as many as where they have. And it's not that much effort. And yeah, it does seem to be that those people just have a lot less issues.
Great. All right. Well, I mentioned at the start that I hosted the trivia night recently, and so I'm just going to end with 2 questions because everyone's done very well to get through that material. I know the budget wasn't particularly sort of groundbreaking this year, but there's still a lot of changes to happen and a lot of things to keep on top of. So, last 2 questions. First one is for John. You mentioned in your presentation that Australia has the 5th largest super system in the world. Who has the largest?
That's a very good question, Claire. Very good question. Are they normally multiple choice, these questions? Jeez. Look, I think from memory, a lot of the Scandinavian countries are up there. So it could be Iceland, Finland, Norway and Sweden. We'll run with that, I think. That's pretty much covers most of them, yeah.
If I could get a fact check at the back, that would be great. And then last question is just a bit of a fact for everyone. So you may know that Jim Chalmers, our current treasurer, completed a doctorate. So he was awarded his PhD in political science from ANU, and he wrote his doctoral thesis on a previous Prime Minister. Can you name that Prime Minister? This is for each of you.
I'm going to say Paul Keating.
Is that because you saw my notes? Congratulations, you're both correct. Well, I think that brings us to the end of this session, unless anyone else has any questions. I think Kurt's going to probably round out the night for us, but I'll hand over to Kurt then.